I'm Allie Canal, and you're taking a live look at the opening bells on Wall Street this Friday morning. JP Morgan Chase ringing the bell at the NYSE, and Pattern getting things popping over at the NASDAQ ahead of its IPO. This comes as traders digest markets that have shaken off September seasonality, pushed through to fresh records, and are now reacting to the Fed's first rate cut of the year. Plus, buzzy headlines out of tech with NVIDIA's big bet on Intel still echoing through the chip trade. Now, Opening Bid is all about serving up investing analysis you need to know to unleash the power of your portfolio. We're digging into what's really moving stocks, giving you the unbeatable context to make decisions with your money. Let's get a quick check on the major averages as we kick off trading and send it down to our own Brooke DePalma live from the NASDAQ in Times Square. Brooke, what are you seeing fresh off those records?
Good morning, Allie. Certainly, we're seeing all three major indices open in the green this morning. The NASDAQ really leading the momentum here, opening up about 1% this morning, up over about 1.3% over the past 2 days after all three major indices closed at record highs on Thursday afternoon. The Dow also moving just a bit higher in this opening hours, up about 0.2%. And we also do have the S&P 500 holding on to that momentum as well, up nearly 0.3%. I also do want to take a look at Russell 2000 because that indice is up 2.5% over the past 2 days, but we are seeing that move higher. If you take a look over the past 5 years, it had its best day on Thursday since 2021, and we're really seeing this as the Federal Reserve did cut rates by a quarter point on Wednesday, and that's leading to some momentum there. I also do want to take a look at trending tickers because we do have FedEx as we make our way into this morning's hours, moving a bit higher, up about now nearly 2%. As you can see right here, over the past 2 days, that company really had quite the moment after the company beat on both the top and bottom line. Its earnings report out Thursday after the bell that really surprised investors after this is a company that really has struggled with the latest trade negotiations. And despite the fact that they had said that they're going to incur a $1 billion hit, really investors here are optimistic about how exactly the company is handling these latest trade policies. We do have UPS really flat here off of that regard into the open, just up about 0.01%. I also do want to take a look at the NASDAQ, which has really led the rally over the course of the summer. That indice really in the green this morning. Intel, I do want to take a look at Intel here. That stock has been under pressure this morning after a note of downgrade after it got that major investment from NVIDIA. That stock over the past 2 days, after quite the run on Thursday, up about 21.5%. And now, based on that downgrade, we are seeing some downward momentum this morning, down about 0.7%. But once again, taking a step back, we did see all three major indices in the green this morning as those trade talks get underway between President Trump and Xi Jinping as well, and also as we hear more from that and those headlines yet to come. Back to you, Allie.
Yeah, we're quite a few things juicing this market. Appreciate it. Well, we're kicking things off with your daily guide to the biggest market drivers of the trading day. Here's what we're watching. Number one, markets back at records with the Dow, S&P 500, and NASDAQ hitting all-time highs. Tech still leading the way with enthusiasm for a deal between NVIDIA and Intel, but participation is broadening with the Russell also notching records on Thursday. Number two, fallout from the Fed's cut. While the FOMC doesn't see quite as many cuts as investors are pricing in, the committee does see 3/4 point cuts through the first half of 2026. Chair Powell's assessment is that the job market is no longer very solid. Could that be accurate? Number three, President Trump speaking to Chinese President Xi Jinping today, and the two leaders discussing trade, tariffs, and of course, a deal that would see TikTok turned over to U.S. owners. Here to break it all down, Drev Krumpelman, Mariner Wealth Advisors Chief Investment Strategist and Head of Equities, alongside Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. And Jeff, I want to start you here with what we're seeing, those record highs. Who would have thought we'd be here after those lows we saw in April? Bird's eye view, what do you make of all this?
Well, you start by saying, who would have thought, right? And so it goes back to sharing our view of the market this year. And our theme going into the year was clear air turbulence, but with the target of 6,600 to potentially 7,000 for the year. And we've been pretty steady while a lot of our peers in that April period that you talk about that was very uncomfortable, the maximum kind of tariff anxiety moment, so many folks took their price targets down. And there was a freak out moment. And, we just in the data didn't see that as warranted. And what kind of keeps us focused and objective is the data, focusing on the fundamentals and what's going on in the economy and earnings and rates, and all of those things were pretty favorable. So we're not surprised to see it. We're also not surprised to see and expect at these record levels moments of air pockets, which is part of the clear air turbulence thesis. Nice. You resume prior altitudes. You have a flight to your final destination that's enjoyable once you get there, but you're white knuckled on the flight and the path to get there, and you kiss the ground when you do get to that final profitable destination. I think that's kind of what we've seen here.
Yeah, and I love that metaphor, Jeff, and maybe we should be bracing for some turbulence. I guess, what do you see when it comes to potential volatility?
Yeah, I just think there are so many things, in your intro today. You're talking about relationships with China, more, kind of trade tensions. We've got a government shutdown kind of thing that's facing us. That's also short-term noise. That's not, long-term scary. But, as we even work through this Fed process, and by the way, we'll probably get into this, we think the Fed's doing the right thing, but, there's speculation and, these grab your popcorn moments as we go into these meetings. Oh, what are they going to do? Is it 50? Is it 0? What about Fed independence? That's just going to cause these air pockets. And when you're at 23 times earnings, yeah, I think you'll get some pullbacks, but I still would have a, expectation of higher highs as we move through 2026 into mid 2026 and further. I think we're on a good path because the data is still good.
Right, the data is still holding up relatively well amid this current environment. You mentioned the start of Fed easing. And Inez, we also have tech continuously leading this rally. I'm curious what you make of what we heard between NVIDIA and Intel. What are strategists saying? And how does this really fuel the NASDAQ rally and what we've seen across the chip space?
Yeah, well, right now we are seeing that strategists are a little bit mixed on Intel, because you've got Citi that just downgraded Intel to a sell, basically saying that the stock is pricing in success in Intel's foundry business. This is the business where they also make chips for customers. They started to make chips for customers, outside customers, in 2021. And this is the big sort of question because this deal didn't include the foundry business. And this is what Wall Street is really pointing to. They're saying that the foundry business is the one that has been, that accumulated big losses last year. This is why the stock last year was down 60%. And so that foundry business wasn't addressed. And the door is open for NVIDIA to be able to give some of its manufacturing business to Intel. But that wasn't part of the deal. And so what Wall Street has been pointing to is that. Now, you do have other analysts like Benchmark, which actually upgraded Intel to a buy, because they're basically saying that NVIDIA's investment in Intel is really a vote of confidence by the most dominant, biggest AI player there out in the industry.
And Jeff, I know you have some thoughts on Intel. How should investors be thinking about positioning within the tech space?
Well, we still like technology. I would agree with the comments, just made about don't get overly excited about Intel. They've had many problems, with regard to their product set and this foundry kind of initiative that they had. They're losing $13 billion or something like that in that effort to kind of resurrect the company, and it's just failed. So they needed this investment. We got a sentiment boost because of what's happened. But we like tech overall, and folks are, I think, somewhat saying, skeptically, hey, is this AI thing a bubble, and we just really do think that we're in the very early innings, and there's so many components to AI as this evolves. Yes, you got Nvidia and Broadcom that will continue to sell chips and are doing well, but you have the hyperscalers also very well positioned with these large language models that are starting to monetize AI applications, Microsoft being probably the best position on that front. But we also see cybersecurity as being very well positioned to take advantage of AI, the networking companies like Arista. And then you can funnel down to the vendors and suppliers that have to feed the power into this infrastructure, like GE Vernova, Corning, and even Baker Hughes that supplies natural gas into this construct. We believe that it's pretty pervasive and is creating so many opportunities and is also driving productivity growth for general earnings and health of our labor market overall as payroll growth starts to slow down. So we like technology, and we would be more diversified as things broaden out.
And we'll be digging into that bubble conversation in just a bit. But Brooke, you mentioned FedEx shares at the open, solid earnings when it comes to revenue and what they reported in the latest quarter. And FedEx is often viewed as a bellwether for the U.S. economy. But given the backdrop, can that still be the case here? Are consumers still resilient?
Allie, it's a narrative as old as time. I mean, all earnings season, this is exactly what we've been hearing. The U.S. consumer remains resilient. And I have heard that from multiple executives that I've spoken to over the phone or with my interviews on Yahoo Finance. And we heard that yet again in the call with investors last night when it comes to FedEx. And what they largely said, one of the executives there saying that they remain optimistic that the American consumer from our numbers has been, key word here, resilient. They went on to say that they'll absolutely acknowledge that July was quite strong for us, especially because of that Amazon Prime Week. And they also said that they're seeing a lot of U.S. retailer sales and market that were affected by this run-up in sales as consumers really seek out value in this environment. They said they saw strong volumes in July, and they don't necessarily see it as a pull forward, perhaps consumers trying to take advantage of prices when they could with fear of the tariff tension looming. But not only has FedEx mentioned this resiliency that we've seen within the consumer, but it's also been echoed in the recent data that we got. Retail sales, for example, out this week from the month of August showed that retail sales for August increased about 0.6%. That was far more than the 0.2% jump that 0.2% jump that the street had anticipated. And what we also heard within that FedEx call was that domestically, they're seeing this robust nature, this robust demand, while internationally, they're seeing some weakness. And so, yes, Allie, this resilient consumer narrative still remains as of right now, and it seems to be heading that way into the holidays as well.
Jeff, do you agree? I mean, you said that job fears are overblown. Can you defend that thesis for us?
Yeah, I sure can. I think even the Fed chair yesterday, and I think he did a wonderful job in that presser, noted that, yeah, payroll growth is slowing down, but there are very logical, rational, structural reasons for that happening. And it's not like there are massive layoffs that are going on right now. Companies are not laying off folks. You just have a slowdown in labor force participation, and as immigration, which was a real driver of labor force growth and participation in prior years, as the deportation strategies take effect, you're having fewer foreign laborers come into the workforce available to be hired, and you're having older Americans, retirees, and the baby boomers retire. So you're going to get a slowdown in payroll growth. And, I think we're at a point where you shouldn't expect 200,000 new workers coming in per month. It'll be more like, 0 to 50 to 75,000 on a monthly basis. And the way the math works, you can maintain a 4.3%, 4.5% unemployment rate as really it's just more structural, not layoffs, just fewer people entering the workforce. And when you have really rising productivity, which is a great thing. Each worker can produce more per hour. You can maintain profit margins and earnings growth with fewer workers. And if you look at the wage growth that you're seeing, companies are able, as productivity rises, to pay higher wages, and therefore that drives spending and income. That's why retail sales growth was very strong this last month. Spending numbers, income numbers, they all look good. That really confirms what was just said about the health of the consumer. We're looking good. We've just got, some slower payroll numbers, and that doesn't mean travesty for the economy at all.
And Inez, real quickly, President Trump, Xi Jinping, that call currently underway. China, the U.S., they're still negotiating. With trade tensions now back in focus, how much of a risk does that pose to the record rally?
Yeah, look, analysts are not so worried about the tariff situation so far. I mean, as far as this record rally that we have seen, they have really been noting that the Fed started to ease into a non-recessionary environment. And you had UBS coming out with a note this morning saying that the returns for the S&P 500 tend to be better when the Fed starts cutting in non-recession. They don't believe that, the analysts at UBS don't believe that the U.S. will tilt into a recession. So you have some bullishness, let's say, from Wall Street about this rally. You even had a fund strat, Tom Lee, talking about the fact that this Fed easing is helping with liquidity, that the Fed is making cash less attractive. This sends equities up, and you even have crypto that has been rallying, and that tends to be a leading indicator for equities. So the street doesn't seem to be too concerned yet about the tariff situation.
All right, Jeff, Brooke, and Inez, stay with me. More opening bid on the other side. Let's turn now to our stock of the day. Apple's new iPhone 17 and iPhone Air are officially available for consumers starting today. And according to research from Start.io, the single most widely owned model across the U.S. is an iPhone 13. So will consumers choose to upgrade? Year to date, Apple has lagged some of its Magnificent Seven peers, falling about 5%. Still with me, Jeff Crumpleman, Brooke DePalma, and Inez Ferre. So Jeff, given Apple's underperformance this year, how important is the success of this latest upgrade cycle? Or do investors not really care at this point? They're more focused on AI.
Well, no, I think, it's very important. By the way, I'd have to add, I have the iPhone 13. So, I get the risk is you feel like a Luddite if you're several.
Why haven't you upgraded? What's the problem here, Jeff?
I know exactly. I'm sure, Tim Cook wouldn't want me to hear me saying that. I don't know if that will reduce our access to, management or not. But it has all the functionality that I want. And I think that's part of the issue. You're really seeing here not evolutionary, AI type of, major improvements here. You got some improvements in form factor and camera and those types of things. So that's great, but it doesn't force me to upgrade. And you'll see, therefore, low, mid single digit growth, in units. And, as a result, I think it's very important to maintain the high single digit earnings growth as a result of what that helps drive. Services is a big part of the business, but you have to continue to see iPhone, at decent levels. We under-own Apple relative to its weight in the indices. And I don't think you don't want to own this company because of its ability to innovate and its services business, but it's trading at 30 times earnings with 8% growth rate, and it's hard to get super excited, about major outperformance when it's at this stage.
Now, despite Jeff not upgrading his iPhone, I have seen many photos of people lining out the door around the globe, including China. And Inez, I'm curious what strategists are saying about China demand, especially since Apple has really struggled against some of those more local competitors like Huawei.
Yeah, well, JD.com had put out some information about pre-orders, and it had seen that pre-orders had surpassed the days before compared to last year for the iPhone 16. So for the 17, especially 17 Pro, seemed to outperform. So that is something positive. You also had B of A that talked about ship dates and that those have been extended in China, and so that's positive for the region as well. But certainly it is very, very competitive. And as far as the ship dates overall, B of A had also noted that it had seen extended times across the board. So that speaks to strong demand for the iPhone 17, the 17 Pro, with some of the features that were just mentioned, like strong, longer battery life, the slimmer phone. So these are the features that not only are they just attractive for consumers, but also the fact that the price point for the 17 is not that much from the previous one, not much higher. So that would make consumers sort of switch to the 17. But certainly it is competitive, but Wall Street seems to, at this point, be bullish.
All right, we'll see how demand can hold up. Now it's time for our question of the day. Let's talk about those recent market highs. So far, stocks have defied the traditional September slump, and there certainly was no reason to sell in May and go away, with records through July and August as well. With the boost from a Fed rate cut, can markets continue at these levels, or could this be the sign of an emerging bubble? And Jeff, I know we briefly talked about this, and I want to pose that question to you. Are we at all approaching bubble territory, or are these valuations justified?
I think the valuations are justified based upon, we're trading at 23-ish type of earnings, which is at the higher end. I can rationalize that based upon the S&P 500 not being your grandfather's S&P 500 when you throw out averages like 16 times earnings as a historical average. Well, return on equity and profit margins were far lower back in those times when we weren't so communication services and technology oriented in these growth names. So I think it can be justified. And if you look at the earnings prospects for these companies, you're talking, earnings expectations that have come up, and they're over 20% earnings growth expectations for, these tech companies, going forward. So absolutely, there are, from an economic standpoint and from a bottom-up standpoint, supports for the S&P 500 being this level. What would worry me is if we got a real melt-up where folks kind of go gaga over Federal Reserve rate cuts, and it carries us to even higher levels. That would make me nervous, particularly if you had a scenario where rates were rising, ironically, as the Fed would cut. So, we're watching really trend in interest rates and, the drivers of this move in the market pretty closely. And I would not like to see a lot of upward drift in PEs from here for sure.
And so, Brooke, given what Jeff was just laying out, what are strategists saying when it comes to year end? Are they still calling for higher highs?
Yeah, well, we've heard from a number of firms that have raised their outlooks for the S&P 500 over the past few weeks, over the past few months. As we make our way, we heard from Wells Fargo, Barclays, Deutsche Bank, all raising their year-end targets. In addition to that, we also heard that some strategists, like Citi strategist Scott, said that the index sits around 6,600, really maintaining that year-end target, citing that equities are fairly valued. But really, all eyes will be on that Q3 earnings report after such robust, as Jeff had mentioned, robust reports coming out of Q2. Now, really, we do see Q3 as the next driver of this year-end rally.
All about earnings. Well, a big thank you to Jeff, Brooke, and Inez for joining me today. Appreciate it. And coming up, Yahoo Finance's Market Catalyst. We bring you the news behind the market moves for the trading day. You won't want to miss it.